For the first time in over a year, monthly inflation has come back up above 0.4%. Now that may not sound like much, but it could be the first real sign that inflation is indeed staging a comeback. Back in the 1970s, jumps in the monthly core inflation numbers were big warning signals that inflation was indeed making a comeback. This black line here is the core PCE, and it's the measure of inflation that the Federal Reserve follows the most. And this jump that we're seeing today in core inflation is putting a lot of people on edge that inflation is indeed about to come back for a second wave, which would be a terrible thing for the US Treasury bond market. Treasury bonds in the United States from their peak in 2020 to their bottom in 2023 dropped 51%. That's the largest drop in bond prices we've seen since the 1980s. It's been a source of massive wealth destruction for investors. The portfolios of most investors traditionally is composed of a mix of stocks and bonds. It's the traditional 60% stocks, 40% bonds formula. These portfolios got absolutely devastated in 2022, seeing the worst annual return for 60-40 portfolios since the Great Depression. Of course, they did recover in 2023, but if we're about to witness a second inflation wave, 60-40 portfolios could be due for another big drawdown. But let's not panic so quickly. Yes, this jump in core PCE to 0.4% looks quite scary for inflation, because that's also what happened in the 1970s, but we also can't ignore that we've seen multiple jumps in the core PCE, even during moments where inflation as a whole was coming down. Many of these spikes in the monthly core inflation number were just temporary and came back down and never actually led to an inflation wave. When we zoom in on what's going on today and I add something called the 10-year break-even inflation, it's actually not confirming the move up that we saw in the core PCE last month. These break-even inflation rates basically tell us how much inflation financial markets are pricing at any given moment. So this is basically a way for us to see what other traders are thinking about inflation right now. And today the reality is that they don't seem very concerned by another surge in inflation. You'll notice that's a very different type of behavior to what we had in 2021 and 2022, where break-even inflation rates were confirming the move up in the core PCE. So when we look at financial market data, it's telling us that this is just a temporary spike in inflation, nothing like 2021 and probably nothing like the 1970s. Because when you look at the 10-year break-even rates from the 1970s and 80s, you also saw them rise significantly, unlike what we're seeing today. Even when we look at what the central bank was doing in the 1970s, they were cutting interest rates very aggressively, despite the fact that the inflation rate at that moment where they were cutting rates was still very high. So essentially, the Federal Reserve was stimulating the economy while inflation was still running hot. That's substantially different to what we're seeing today, where interest rates are still at quite high levels, despite the fact that inflation has come back down. We can see how much the central bank interest rate that you see in black here is affecting financial conditions. This is what financial conditions look like today. This is what financial conditions look like in the 1970s. The higher this line is, the tighter the conditions, the lower this line is, the looser the conditions. Back in the 1970s, the Fed loosened financial conditions very quickly, and surprise, surprise, these loose conditions stimulated the economy and led to a surge in inflation. Fast forward to today, not only is inflation at much lower levels than it was at any point in the 1970s, but we have financial conditions that are very tight, not at all suggesting that we should be seeing this huge surge in inflation again. Quite the contrary. But what about deficit spending? Isn't that what's fueling inflation right now? Basically, the total amount of money circulating in the economy. We can argue that this jump in the money supply that we saw in 2020 and 2021 as a result of massive levels of government spending was the core reason behind the inflation wave that followed. But now the money supply is coming back down to the same trend that it's been at over the last 15 years. So again, not telling us that we're seeing this huge boom in liquidity as a result of deficit spending and that that's going to translate into a lot of inflation. That's probably going to happen at one point in the next few years when the government needs to respond to the next downturn, just like how they had to respond to the COVID shock. But that's not what's happening right now. Today, inflationary forces are pointing down because there's less money in the system than a year ago. And we can see that through charts like this that are showing the least inflationary pressures since COVID-19. This is a chart of a survey from the Federal Reserve Bank of Philadelphia that shows us how much businesses are paying to produce their goods, and it happens to be extremely correlated to inflation. When the cost of production for businesses rise, inflation ends up rising soon afterwards. That's what was happening in 2021 when we had a massive amount of inflationary forces that fueled this breakout in inflation. Today, we're not seeing that. In fact, we're seeing the opposite happen, where prices paid are coming down to levels comparable to COVID-19 and 2015, all periods that saw inflation actually come down to zero. And when we zoom out, we also see it's a very different picture to the 1970s, where the survey of prices paid was also extremely elevated, in fact, at the same level to what we saw in 2021. Does that look anything like what's happening today? No. In our opinion, over the next year, the inflation story is dead. And that's fantastic news for U.S. Treasury bonds that could finally begin to recover from their massive 51% bear market. When I invert Treasury bonds and I plot them against that same chart of the prices paid survey, you can see there's almost a perfect correlation between the two. But you can see Treasury bonds today are still very concerned about inflation. They're acting like a second wave is about to come, when the data is telling us that the inflation story is not coming back. That's almost a perfect mirror image to what we had in 2021, where the prices paid survey was surging and staying at extremely high levels, while the bond market didn't actually seem to be pricing in those inflationary pressures. Treasury bonds are extremely slow to react to reality, and so that creates opportunity for traders like us who are willing to take some risk. Treasuries look like they're about to snap back to reality. And if we look at the technical chart of TLT, the Treasury Bond ETF, it just broke out of an important level. It's been retesting that level, waiting for what we believe is going to be the next big run on Treasury bonds, where the immediate target for TLT would be around $109. That's why we initiated a trade on the website. Now, we could be dead wrong about this. We thought TLT had made a significant bottom in late 2022. We were completely wrong on that. If we see a couple more hot inflation prints, you could see another big letdown on Treasury bonds. In terms of stop losses, we're eyeing around the $90 level. If price really confirms a break below that, it really doesn't look good for TLT. The most important aspect of trading is to know that you can absolutely be completely wrong, and so have a plan to limit your losses if that's the case.